Good morning, ladies and gentlemen. I'll call our meeting back into session. Dr. Lipper, did you have a question?
Yes, Mr. Chair, before we started with the panel, I almost overlooked this, we do have the revision requested by Chairwoman Hazelwood on Article 3, Section 18 as, and there she is. We do have that revision. We've reworked that language, and if you want to take that up now, or if you want to wait until after the panel.
I think we ought to wait until after the panel because the chairman's just arriving, and chairman may want to look at it and proof it before we vote on it.
Very good.
All right, and if that's all right, and there's no objection, that's what we'll do. We'll go to our panel. We have a very distinguished panel today who's going to talk about tangible personal property tax, and I'm going to ask our research manager, Michael Mount, if he wouldn't introduce the panel to us and get us started.
Thank you, Chairman. Commissioners, this panel is in response to a request by Senator Lundberg at our January meeting. The Commission is studying the personal property tax in Tennessee, and we plan to complete a draft report by September 2022 meeting. That report will examine the cost of businesses, large and small, to file and pay the tax, compliance levels, variance among local governments, large and small, as to the percent of the tax collected to overall revenue bases, cost to local governments, large and small, to collect those delinquent payments, possible revenue replacement models that would be fair and equitable to businesses, both large and small, and to local governments, and to recommend actions on eliminating or reducing the tangible personal property tax burden on businesses and local governments. In other words, phase out or one time. For the purposes of taxation, property is either real or personal. Tennessee's Constitution requires that local governments with a property tax apply that tax uniformly to all commercial, industrial, and public utility property. And the state constitution defines personal property as all property that is not real and that are articles of value that are capable of manual or physical possession. Today, the Commission will hear from our panel of 6 experts with knowledge on this issue. Jim Brown is the State Director of the National Federation of Independent Businesses. Will Denami is the Executive Director of Tennessee Association of Assessing Officers. Kelsey Jones is an attorney with the Jones Law Office. Kevin McAdams, CPA with Elliott Davis. Karen Paris is the Williamson County Trustee. And finally, Daniel Sohn is the Vice President of Finance and Operations with Vireo Systems. And with that, I will turn it over to the panel.
Okay.
Yeah.
So me first? All right. Thank you, Chairman. Jim Brown with NFIB. I'm the State Director representing 6,500 independent business owners across the state. Some of them are here today. Kelsey Jones is an NFIB member. Kevin McAdams, Jones Law Solutions. Kevin McAdams with Elliott Davis. And Daniel Sohn with Vireo Systems. So we're grateful that they're here. Chairman, thank you for convening us. I mean, this is very important to small business. And when we started this journey back in the summer, we were getting together with Mr. Denami and Ms. Paris and others and just talking about the frustration with the administration of this tax for our members and how complex it is. And so we just had really good conversations last summer. It progressed. We started learning how complex this was. And when we talked to Senator Lundberg, who's not here today, he said, we need to hit the brakes, and we can get this done through TACIR. You all passed this in January. I got to know a lot of mayors, thank you, for agreeing to do this. And that's why we're here today, is to talk about the complexity, but also the opportunities to improve the system or do a major overhaul. So we're very grateful for that, Chairman Yeager and members of the committee. I'll just start with some background and some general observations. Last summer, I mentioned that we engaged parties to discuss challenges with the administration of the tax, and we shared we were interested in establishing a de minimis threshold, exempting smaller businesses from paying the tax. You have states like Indiana and Texas and Michigan and others that have done that in recent years. There's a trend. So that's where we started our conversations. Well, we did learn that there were some constitutional issues with that. I believe it's Article 2, Section 28. And so we hit the brakes there and didn't bring a bill. Talked to Senator Lundberg. That's why we're here today. We also learned that there are states like West Virginia and Wisconsin that are moving full steam ahead. They're looking to get rid of their version of the tax. Wisconsin the legislature passed a full repeal of it. They did a schedule at first a few years ago, and then they fully repealed it. And I believe it was about $200 million, and the governor vetoed that. And so that's in limbo in Wisconsin. In West Virginia, there is a measure there's a ballot measure to get rid of this tax, I believe this November. So those are things we were learning. Just a couple of comments, and I think Kevin and Daniel are going to go into more detail about this. But this is the bottom line. Many of our members, small, medium, even large sized, often spend more money in tax compliance costs than the actual tax they pay. Our smallest businesses often spend hundreds of dollars to pay a tax that can amount to between $10 and $25. And I think Ms. Parris's numbers will bear that out. Our mid-sized and larger companies spend even more time and money to comply, in time researching new purchases and filing the schedule, in time away from their daily functions and growing their businesses, and in paying tax experts to review and file their paperwork. It's a lot of red tape. You're going to hear about that. Consistently, many NFIB members have said they believe this tax is a double tax. They've paid sales and use tax on the equipment up front, but then have to pay the tax for decades, sometimes paying more in tangible personal property tax than the initial sales and use tax. NFIB member Gary Floater with CHC Mechanical in Cookeville, he gave some great examples of this to Mr. Mount, and I believe they'll be in the study. In closing, small business is very eager for relief from this burdensome tax. We're eager to learn what TACIR's recommendations are. And Mr. Chairman, I'm just really grateful again for this opportunity, and I'll be prepared to answer questions at the end of this. Thank you.
Thank you, Mr. Brown.
Thank you, Mr. Chairman, and thank you, members of TACIR. My name is Will Denami, and I'm here on behalf of the Assessors of Property. And I want to thank Senator Lundberg, and also want to thank Jim Brown for bringing this up in the NFIB. Like you said, we convened last summer and talking about this issue. It's really pretty complex, and so there's a lot of people that Jim got around the table to talk about it, and we've had several meetings amongst Assessors of Property, and we've been talking about this for years in terms of, is there a way to make this system better? And the simple solution assessors came up with and voted on was to just have the Office of State Assessed Properties take over personal property. I say that kind of as a joke, and I'm sure the director doesn't really want to take that on, but it's pretty a complex system, and there's some case law, and there's been years and years of developments. Of course, it's required by the Constitution, and Article 2, Section 28 breaks down personal property into different subclasses, and then even further into intangible personal property. I would say Tennessee has a good system, but it can be better, and Assessors of Property would like to be part of that solution. As you go through and discuss and look at different ways to really improve the system, there are a couple of remedies that are in play that I just want to bring forth to make sure that everybody's kind of front of mind. One of them is a settlement from New Year's Eve of 1996. And that settlement has put in place a 15% discount for all central assessed properties. And the basis for that 15% discount is that the current personal property schedule that's in the code undervalues property. And so from the Assessors of Property perspective, they want to treat everybody fairly. So the system really needs to, reflect fair market value. And if there's an opportunity here to really improve the personal property tax process, let's make sure that we treat everybody fairly. That would be at the front of mind. So as we go through this, I look forward to answering any questions. And again, I appreciate the opportunity to be here. Thank you.
Mr. Chairman and members of the Commission, I'm Kelsey Jones. I am a lawyer in private practice now, pretty much limiting my practice to property taxes, but most of my public career. I retired in 2017. Most of my public career was spent at the State Board of Equalization, beginning in about 1984, latter part of 1984. So I've witnessed a few of the changes that, and there have been many over that period of time. The property tax is a local tax. It was a state tax as well until about 1947. And at that time, there was a nickel annual levy of state property tax, and it was replaced with the sales tax. That was the first year, I believe, roughly, of the sales tax. The state involvement in the property tax began probably 100 to 125 years ago with the problem of assessing multi-jurisdictional companies, railroads, power companies, telecommunications, other transportation companies like motor carriers and barge lines and so forth. They do business in multiple states. So under the federal Constitution, the states had to figure a way to reasonably apportion the property of those multi-state operations to the individual state. And so a state assessment mechanism came into play. It was originally the Railroad Commission, and then they added telegraph companies. Even I remember what a telegraph is. And so there was that state presence, and the state formed a staff of appraisers at the Railroad Commission. They now are under the jurisdiction of the state comptroller, have been for decades. And it created an instant dichotomy between these large centrally assessed companies, multi-jurisdiction, multi-state companies, and the local assessments. The local assessments, there was originally a panel of assessors in each county, one for each civil district. I know y'all know what civil districts are, but they don't make, they don't have a lot of impact these days necessarily, but once upon a time, they each had an assessor. And they would meet annually, those assessors, as a board of assessments and equalization. And they'd kind of talk about, well, what have you got land on, good farmland on, and what are you assessing, a well-built house for? And they would work that out. And there was an appeal process set up before that board, and they would go through a process of equalization, trying to make sure that they treated all property owners within the county roughly the same. But the tax is old. It's been there a long time. Most of the impetus for change over the years in Tennessee, going back to the 1971 constitutional amendments known as Question 3, most of the change was the result of tension between those centrally assessed companies who were assessed every year through an ad valorem report filed with the state and taken up by staff appraisers and rendering it into a value, and that's still going on. Tension between that process, which was widely accepted as yielding fair market value, and what goes on locally, where often, well, you never knew what was going to happen locally. But the percentage of assessed value to true value prior to Question 3 was down around 20 to 30% at the local level. Question 3 changed all of that. And the Classification Act that came out of Question 3 created a state division of property assessments in the comptroller's office, the director of which is here, Brian Kinsey, today, and knows a lot more about it than I do. And the state process, the mandate that all property at the county level be reappraised at least every 10 years, and later they shortened that to 4 or 5 or 6 years. All of that, and a program of professionalization of the local assessor offices where they both encourage training and conformity to international standards of assessment, and they also created a small pay supplement to encourage assessment staff to take them. All of those things brought Tennessee to a point where we were, if not the envy of other states, we were certainly in the top tier of states in our property tax administration. And that can be said absolutely to be still true today. Probably got better since I left in 2017. Jones probably got in the way now and then. But personal property is a little different animal. Prior to 1988, it was up to the assessor how to determine the value of that property. It had to be reported by businesses then, but it was up to the assessor how much depreciation to allow. Some counties came up with their own standards. In Hamilton County, I can't remember who the assessor was then. Well, when I came to the board, it was Claude Ramsey. But they would allow you an immediate 50% write-off on your tangible personal property. So all tangible personal property in Hamilton County was at 50% of cost. Cost is the easiest reference factor for tangible personal property. Other counties would do it differently. In 1988, again, at the urging of these centrally assessed companies who were looking at the low levels of assessment at the county level and saying, why not me? Why do I have to pay at full value? But in 1988, the State Board of Equalization promulgated uniform standards of assessment. And the legislature basically took their work, tweaked it, and put it into the statute, whereby now, and that was in about 1991, now we have mandated levels of depreciation, mandated groupings of tangible personal property, every taxpayer filing a schedule by March 1, it having been provided to them by the assessor. For the most part, automated methods where the original cost for that machinery and equipment would be entered, and according to year of acquisition, and a percent good factor or depreciation rate would be applied to bring costs down to value. That process is similar to what you see in other states. It's a more difficult tax to administer, obviously, than the real property tax. And one of the early innovations was to find a way to ignore very small levels of assessments. I went from being partly an administrator to paying a personal property tax as a lawyer in Davidson County. And I took advantage of that first. I didn't want to tally up. I rented my office. I didn't want to tally up what my used computer was worth. I checked that $1,000 box. So I got a tax bill, and I continue to get it from Davidson County, which is, $30, $40, something like that. And I pay that along with my state due taxes. I have no recommendation to you about getting rid of that tax because it is a substantial revenue generator to local governments. And it would have to be replaced, obviously, but we've done that before. We have had to try to achieve equalization between centrally assessed companies, or some of them, and locally assessed companies through equalization means in the statute before, and we found ways to hold local governments harmless. So there are ways to do that, but they require a constitutional amendment, because the property tax is spoken of more in the state constitution than any other tax. I want, as I indicated in the material I provided to Mr. Mount, I'm happy to serve as a resource and in any way I can, and look forward to working with the other panelists, with my old friends at the Comptroller's office who have played such an important role in the assessment, in the administration of the property tax, and with the staff of the commission. And I certainly always welcome any questions. I'll do my best with those.
Good morning, Chairman Yeager, members of the committee. I'm Kevin McAdams, a CPA and tax shareholder with regional public accounting firm L.E. Davis. For almost 30 years, I've worked as a tax and business advisor in public accounting, serving closely held businesses, family businesses, if you will, of all sizes and diverse mix of industries. All of my family, interesting enough, for business owners as well, every single one of them. So I have a somewhat unique perspective, personally and professionally, on the challenges companies face when dealing with a lot of tax compliance matters, particularly on the subject of today. In my experience, and that's commonly understood in our industry here in Tennessee, the cost of compliance to a company is often more than the annual Tennessee personal property tax itself. Now, there are two main and impactful cost components for businesses to comply with the tax, and they're somewhat intuitive. One, back up, the company's own personal cost and outside professional fees, with one, maintaining the data necessary to comply with the tax, and two, the costs associated with the inevitable audits of personal property tax returns. Related to the cost, company has internal personnel cost to keep up with these assets, but usually also pay outside professionals, like CPA firms, to maintain the detailed fixed asset schedules and backup of records. Now, one might say, well, you already have to maintain these same records for book, accounting, and tax filing purposes. So where's the extra cost companies actually paying the tax? Well, let me explain. About 10 years ago, the IRS provided significant relief to taxpayers with the so-called tangible property regulations. In simple terms, the regulation codified a rule allowing automatic expensing of individual personal property assets below $2,500. So in other words, you didn't have to put it on a schedule and depreciate it, you just wrote it off. And in some cases, under rather complex rules, it can even be up to $5,000. Further, general accepted accounting principles, or GAAP as it's known, allows for the same identical expensing policy, so book and tax can be the same. The reality is companies do not have to maintain the personal property asset schedule for their accounting or tax, but must only do so for the purposes of the Tennessee personal property tax. As a result, companies incur significant personnel costs and outside professional fees to help consult or actually maintain the data. Now, this data is meticulously maintained for this also second point of the audits. Now, it's important to emphasize we're discussing a tax with the following applicable phrase. It's not a matter of if a company is audited, but when. And this does not really apply to any particular tax in my almost 30 years of practicing. So hence, the audit should be at least some part of the discussion. Now, during an audit, just like the annual cost of compliance, a company's resources and professional fees incurred are more than the tax itself being audited or even any audit adjustments that are finally issued, if any. This disparity is often further exacerbated by the audit process itself. And while the audit process by the hired outside consultants is certainly a complex topic for another day, I believe the committee should know the following. The auditor is reviewing a plethora of assets, requiring a significant amount of work by the taxpayer, gathering the requested information, and the related inherent back and forth over this process. And unlike other federal and state audits, it is a virtual guarantee. In fact, in my career, a guarantee. There will be a dispute over those results. The taxpayer is often faced, however, with a cost-benefit analysis that is simply cheaper to walk away. And in no other tax administered is this basically uniformly the case. In closing, I want to thank the committee for taking on this project and the opportunity to speak to you today, and happy to answer any questions.
Good morning, Mr. Chairman and members of the committee. So I'm Karen Parrish, the trustee of Williamson County, and I'm not speaking on behalf of all the trustees, although I have had many conversations with county trustees across the state.
Excuse me, do you mind pulling your mic a little bit closer
sure.
to you?
Sorry. So I'm not speaking on behalf of all the trustees, but as the trustee of Williamson County. And but as I told the gentleman to my right and left here, trustees, I think, are uniformly in the corner of our business community. We are here elected to serve our citizens and being on the front lines and collecting these taxes. We hear day in and day out the confusion, the questions, frustration, particularly from small businesses. While some of the mid to larger businesses and some small businesses do have to employ CPA firms, et cetera, a lot of them rely on their local assessor, their assessor's office, to try to help them fill out the personal property schedules. And I didn't come so much with a prepared statement, but with a few figures that are kind of a snapshot of Williamson County. The total tax roll that our office collects, we collect for Williamson County, 4 cities and a special school district. Last year's $378 million. Of that, $10.8 million is personal property taxes, 13,120 accounts. But I think the shocking thing and sort of thing that reveals the issue is that 7,090 of those 13,000 accounts were $100 of tax or less. And if you aggregate all of that together, those 7,000 accounts only produced I'm charged with collecting $210,000 to $294. So if you take it down to taxes between $1 and $10, that's 2,863 accounts. Tremendous number of accounts that are just tiny. The assessor of property in Williamson County, Brad Coleman, and I have talked about this several times, and he estimates that 2 of his staff members could be eliminated, transferred, absorbed, et cetera, if these $100 and below accounts were not having to be administered by his office. I have a staff member that spends at least equal to a staff member that spends all of our time researching return mail from businesses that have opened and closed, these small businesses, tracking people down. Our staff spends all summer calling delinquent personal property accounts and trying to explain the process to very confused business owners who don't know what it is, didn't file their schedule, received a forced assessment, didn't close the business out, so are assessed for years after they've closed, end up in the court system, and so it's just a challenge. We understand the importance of the revenue to the county, and our job is to collect it, but that's what I'm here to do, is answer questions that might pertain to the challenges that once it's handed off to the collecting official in dealing with particularly the small businesses and their concerns and frustration. Thank you.
Good morning, Chairman Yeager, committee members. Thank you for allowing me to share my testimony this morning. My name is Daniel Sohn, and I'm the Vice President of Vireo Systems, based out of Madison, just north of downtown Nashville here. At Vireo, we develop, manufacture, and market holistic products for people that enhance the life of people and pets. We're in a very rapid growth stage. In the last 3 years, we went from 20 employees to almost 90 right now at 4 locations across 2 different states. So we appreciate any state efforts that help us reduce the red tape that inhibits our ability to grow and add new jobs. Along these lines, we recently conducted a top-to-bottom review of requirements to comply with accurately filling out the annual tangible personal property tax. And we learned a great deal about how this tax is administered and collected. In short, it is extremely burdensome to medium-sized companies like ours, and I'll explain why. To comply, we have to report 2 groups. The first is a list of furniture, fixtures, and general equipment and other items, which contain a list of more than 40 separate items. The second list is for computers, copiers, peripherals, and tools. Following the letter of the law, what this requires us to do is to document every single piece of equipment, furniture, or fixture that is in our office building or warehouse or wherever. So just at my desk alone, I have a stapler, a tape dispenser, Post-it notes, I have 10 pens, a laptop, a keyboard, mouse pad, a desk organizer, a small calculator, a docking station for a laptop, a notebook, a desk, and a chair. So what that means is I have to document every single piece of this, of everything on my desk, and then determine the acquisition cost. And then follow this procedure for 39 other employees across my 2 sites here in Tennessee. And this review does not even include the things outside my desk area, or in my lobby, or in my conference room, or in my warehouse. As you can see, it got very overwhelming when I first saw what the requirements of this tax required. But because we're not a new company and most of our items are captured in the past, we took a little different approach this year. To follow this submission to the letter of the law, we went through our annual income statement month by month to identify all the purchases, every single transaction that could pertain to tangible and personal property. It took our staff accountant 4 whole days to compile this list. And because we're a mid-sized company, we process hundreds of invoices on a weekly basis. So this was not a simple task for them to go through the entire year. I then sent that list to our facility manager, who then had to walk through our 2 sites and put his eyes on every single item that was on this list. I had him searching for a $7 stapler that we purchased back in March, and I can tell you, he was not very happy. It took our facilities manager and his assistant 3 days to identify and locate every single item on that list. I estimate we spent over $2,000 to complete our personal property tax inventory and review. And to be truthful, if we were subject to an audit, I guarantee you it would take longer than a week to try to reconcile what we submitted. So in summary, I asked my team to do their best to follow the letter of the law of this tax submission. It took 3 staff members more than a week and a half to comb through the data, identify every single tangible property we purchased. It was essentially like asking somebody to go home and put together a list of every single tangible item you have in your house and then figure out the acquisition cost. It just was really overwhelming to start with. So I'm really grateful for TACIR to taking a long look at the burdens of this tax on Tennessee businesses and others. I ask you as state leaders to continue to work to identify a better way for us, whether it's lessening the burden or even a full repeal. I believe from my experience, the complexity and compliance costs creates a burden on companies that far outweigh the taxes that would be collected. So thank you for allowing me to share this information, and I look forward to answering any questions.
Thank you, Mr. Chairman. I was talking to Barrister Jones earlier, and I just want you all to know that Kelsey's been before TACIR many times over many years, and when we've dealt with the complexities of the property tax issues across the state for so long, he was always the go-to guy. So he's being modest in his remarks here earlier. He was the guy that came before us and gave us a lot of good information every single time, and I never failed to learn something from Kelsey Jones whenever he testified before the TACIR's committee. So I thank him for being here this morning. I was glad to see he's on the panel, and I also thank him for all those years of service to the state and supplying great information to this committee as well. It bothers me that compliance expenses can be more than the tax. It bothers me that strong companies have to figure out the complexity of how to pay the tax, and it bothers me that assessors and the state folks have a real issue with trying to be fair and not knowing how to be fair in many cases. The intangible personal property tax, how in the world do you figure something like that? I just don't know. So I suppose the first thing, Mr. Chairman, I would hope in this study that we would have some kind of an allocation chart that shows how much money this personal property tax is to each county in the state. And I would also hope in the study we would look at other states to see if they're handling this issue better than we are, or in some innovative way that can make it less complicated. One of the specific questions I had, and I'll direct it to Councilor Jones, is pipelines. I remember pipelines years ago were a real issue coming before this committee, and now pipelines have the ability, they may be transporting petro products or maybe natural gas or some other, they can switch back and forth. How do you tax a pipeline when it's got the ability to do that?
The pipelines, of course, being one of those centrally assessed companies, would file basically an ad valorem report that reflected the entire value of the system through multiple states. And then the trained appraisal staff of the Office of State Assessed Properties, which is the second property tax division in the Comptroller's office, would take that report, allocate appropriately to Tennessee, distribute appropriately within Tennessee to the various cities and counties. Changes from year to year. There is in the valuation formula, I should say the valuation approach for these large centrally assessed companies, they look at the traditional 3 indicators of value: cost, market, and comparable sales and income approach. They'll look at all 3 of those indicators and do the work of a typical appraiser would. So they'll take the information they get from that report, and whether that pipeline is transferring gasoline or petroleum or some other product, they view that as a transportation. They'll look at how the income has changed. They'll look at the costs of new equipment that have been added and so forth. It's a very meticulous process. and they do a great job at it. The assessment level, the biggest controversy that you may have heard in recent years, and it ended up in court for many years, was the assessment level for pipelines.
That's right.
Public utilities, under those Question 3 constitutional amendments, are assessed at 55% of full value. So the tax rate locally is applied to a distributed assessment that represents 55% of the company's value. For local companies, it's either 40% on real property or 30% on tangible personal property. The ad valorem report filed by a centrally assessed company, such as a gas pipeline, includes all their assets, including intangible property. There is no mechanism for assessing intangible property to local businesses. So there are vestigial intangible personal property assessments through certain kinds of companies, cemeteries and insurance companies and financial institutions. And in most of those cases, the legislature has imposed a replacement tax that is administered at the state level with input from the assessor to meet that intangible tax. That tax has virtually disappeared, although it is still a substantial portion of the public utility, the centrally assessed companies taxes. So most of that controversy involves that assessment percentage, and it still remains at 55% for pipelines. For railroads, motor carriers, airlines, it is now subject to federal preemptive legislation that mandates that those kinds of companies cannot be assessed at any higher level than local businesses.
Yeah, companies that provide information, high-tech companies that are providing, it's an information highway now. How is that handled, Mr. Jones, in regard to, are we taxing companies? How do you place a value on a company that's providing information?
It would have to first have a situs in Tennessee, and of course that varies with tangible personal property because it's movable. But there are rules for determining what that situs is, and they're generally not controversial. So if they fall within the category of a public utility company, as I've described it, transportation, power, and so forth, then they would be assessed centrally and allocated and distributed. Otherwise, the local sited property in a county would be assessed by the local assessor. They do their best with it. Land and buildings, of course, fairly straightforward. Tangible personal property, they would expect to see a report from that company listing cost in those depreciable categories.
Do most states across the country have these, the property tax administration, the assessment and all, embedded in their constitution? Or is Tennessee unique to that?
Tennessee is not unique, but there are many states that do not address the property tax specifically in their constitution. We go back to the early 1800s setting a property tax, referring to a property tax in the state constitution.
And then my last question, Mr. Chairman, if I could. In Tennessee, when we're recruiting industry, we set up payment in lieu of taxes, and most as an incentive to come to Tennessee. It's all jobs-driven, investment-driven. You provide this. You put clawbacks in the payment in lieu of taxes. You provide this number of jobs. This is what your incentive is going to be. And that's a way of, the courts have ruled that a payment in lieu of tax is a payment. It's not a tax, it's my understanding. Are there any states that you know of in our region or across the country that are doing something like that in terms of a framework for trying to help with the complicated issue of personal property tax?
I don't know of any incentives that are directed specifically toward a particular burden of the property tax or the compliance costs of a property tax. The incentives that you mention, of course, are every state provides an incentive. TACIR has studied that issue on multiple occasions. There are multiple tax incentives involved, many of them non-property tax, but the property tax is as well. And most typically that shows up where a negotiated arrangement is in place between the city and county on the one hand and the business that's being recruited, where an industrial development board,
a tax-exempt
governmental entity will take nominal title to the property, lease it back to the business and the lease payments will include a component, a pilot component, payment in lieu of tax based upon a percentage of what tax would otherwise be due in the absence of the arrangement. That is done in every county these days, some to a greater extent than others.
And then the percentage of your payment in lieu of taxes that you pay generally goes up each year, and the depreciation schedule on your equipment all generally goes down each year to come up with the amount of money that you're going to pay over 10, 20, 30 years, right?
Well, it's true that tangible personal property generally does not appreciate. It wears out, it becomes obsolete, so replacements is the biggest source of growth for tangible personal property. Real property, on the other hand, can and does appreciate occasionally as well as depreciate, and obviously we're seeing a market now where real property is the more significantly dynamic portion of the assessment base.
Thank you, Mr. Chairman.
Thank you, Executive Huffman. And I just wanted to follow up on a couple of comments you made, and I'm sure others want to speak too as well, but I think it's very important and noted by the director that we do need to take a look at what this personal property tax generates on a county by county basis and statewide, because I believe this is a locally levied tax, or your county commission. So you have 95 counties, I presume, that have this, and I think my question was one of my questions was answered in the testimony that the audit responsibility is the local assessor. Is that correct?
Correct.
Okay, so that's enough. And so you have to look at the loss of revenue to the local government, but on the other hand, I appreciate the trustees' statistics. I was it just really reaffirms the concern that we need to look at these other states to see if there's any best practices to give some relief to these people who are spending hours to pay a tax that's going to be less than $100, or even in some instances less than $10. You know, that's just back home we'd say that's pouring good money after bad, and we need to. So I'm hopeful that when we do our report, that we'll try to look for best practices there, to see if that's an issue that's not only a burden to the taxpayer, but it's also a burden to the taxpayers, because the assessor's office is spending a lot of their time, and probably staff, to do that. So that said, I think we've probably got everybody warmed up now. Councilman Carlisle, you're next.
Thank you, Mr. Chairman. Very good points. A lot of themes between yesterday's panel and today about red tape versus proper oversight, and the difference between small players and large. In Shelby County, most of the large players aren't necessarily impacted because we utilize pilots on personal property taxes, where pilots are our main economic incentive in our package outside of cash, and we very rarely utilize cash without our partners at the state. What was interesting is you mentioned the idea of double taxation on sales and use tax, and it's really triple. Because if you're a large user or you're a hotel developer, you're going to pay the sales and use tax when you build and develop. You're going to pay the personal property tax to the county, and then you're going to report on your balance sheet as a part of the franchise tax when it's something like a hotel as a tangible asset, as we're giving our percentage. So we're actually getting hit three different ways. So it's certainly something that as a business person, that's how I see it. We're fortunate enough, again, back to your point about small and large businesses, that we can hire a Deloitte or KPMG to do a cost seg when we stand up a building, but most small, even developers or restaurant owners or independent operators cannot. But I am curious to see the overall economic impact in those three buckets if you were to add an exemption class to some of these, but where we always have an issue, at least again on the business side as a developer and an owner-operator, is the fact that we're getting hit three separate times for it, and then twice on an ongoing basis. And it may depend on the hold schedule, right? So some people are long-term holders, and so they may not take accelerated. They may straight line. And so they're just different things as far as their federal taxes go and what they choose to do. But it always comes into play. So I'll be very interested to see what this panel and this research determines as far as opportunities. And then back to the local burden, when you look at a city like Memphis, it's a constant ebb and flow of what's going on. We have many neighborhoods that are appreciating in value, and we have many neighborhoods that are depreciating in value. And so if you look at the assessor's office and the trustee's office, it's almost an overwhelming task for them. And so, and Chairman Yeager brought this up, and so did the executive, which is the opportunity cost for small businesses. You know, having your facilities manager running around trying to find a stapler isn't the best use of time. And so, and there aren't very many resources either for small business owners to go out and get that kind of advice on the front end, right? And as we discussed yesterday, even with grants, you know, they may not even know where to begin. So anyway, I thank you for your time, and I really look forward to this debate, especially personally. We're in the process of trying to build a 24-story high-rise hotel in Memphis. And so this conversation is critically important as we start to look at rising interest rates and a macro environment that's uncontrollable. This would certainly be an interesting controllable, but that's what the business hat on. I'll be interested to see with the government hat what the economic impact to the state is, much like the repeal of the whole income tax. So thank you.
There are other questions, comments? Yes, Mayor.
I've heard the same horror stories that what you're talking about, and I certainly agree. And I guess I have two questions. One, I guess, is there a way to reduce and simplify this without having to have a whole new constitutional amendment? The other, it seems like sometimes, and I am, you know, certainly headed in the direction that what you all have to go through is certainly uncalled for. But like Mr. Carlisle brought up, what is the burden on the local communities? And it seems like sometimes these local communities, because of the decisions of the legislature to reduce taxes or eliminate certain taxes, that's revenue that goes to these cities. And so what do we do to make that up? And I guess a question is, in order to kind of level the playing field, if this is something that we're considering to reduce or eliminate, you know, would the legislature look again at the state shared sales tax and the single item tax, because those are funds that I mean, the cities are the largest initiator of this revenue, but it's being taken away. So if this is taken away also, and right now I think that it's ridiculous what you're having to go through. Where are we going to turn? I mean, how are we going to make that up?
Mr. Chairman, thank you, Mayor Holland. I think on the first part of this, we thought that there was an opportunity for a de minimis threshold, but we had very smart people in the room like Mr. Jones that said, whoa, hang on here. And, Indiana started at 20,000, a threshold of 20,000. I think they're up to 80,000. They're being very proactive. I don't think their constitution limits them. Michigan's at 100,000. Texas just moved up to 2,500. I think Utah's at 40,000. So we were having those conversations, but that's when we hit the brakes, because I think if you put in a threshold and you all at the legislature agreed to put that in place, it's probably going to get challenged depending on where the threshold was decided on. So what do I mean by that? I think Ms. Paris in Williamson County would have loved a $20,000 or $40,000 threshold, those 2,800 accounts that she talked about. But there may be a county out there that you're now really getting into a higher percentage of our revenue, and they don't look at it like Ms. Paris does. So we could have had a lawsuit, and we don't need that. So that's why Chairman Yeager and Senator Lundberg thought that this was the right body to do that. I'll let the others answer the second question or chime in on the first one. But while I've got the mic here, Mr. Chairman, we've had 6 or 7 members interviewed by TACIR, And Mr. Lippert, Mr. Mount, and I did an interview with, I think, 3 or 4 TACIR folks. And I can't speak high, they're just terrific folks. They're very professional. All of my members, again, they said that. And this is a body that it's been an honor and privilege to engage, and we're really looking forward to that report.
Other panel members? Yes, Mayor Frank.
I have a few questions. So you mentioned in Williamson County that 7,000 plus of the accounts only collected 210,000. So obviously those are a lot of very small businesses, mom and pops. I'm going to use a little analogy before I ask my question. If we set the speed limit on the interstates at 20 miles per hour, we could save a lot of lives. But in all honesty, probably universally, no one would follow that law. So is it that everyone is a bunch of lawbreakers, or have we set, bad law, bad speed limits? So on the small businesses, I'm wondering how many accurately report their actual furniture and fixtures from a small business level, or are they just spitballing and throwing some numbers on their sheet, hoping to maintain compliance? And then do we ever audit these 7,000, or are the assessors only making decisions to audit just the mid and large level? Are they looking at it from a return on investment that will audit those? And then I have one more follow-up after that.
Will, would you like
Sure.
Some of that was for the assessors, I think.
I can start with that. Thank you, Mayor. The settlement that I mentioned back from New Year's Eve of 1996, in addition to the 15% discount for the Office of State Assessed Properties, like Mr. Jones was talking about, the conflict between central assessments and local assessments, there's an additional 5% discount if there's not an audit program. And so I guess part of the discussion was, is there a robust review of the self-reporting? So there is now. There's a program in place. The Comptroller's Division of Property Assessments oversees that program. It's, there's a random sampling. There are desk audits that the assessor's office performs themselves, and then they hire specialty audit firms that go out and look at individual properties. And so sometimes those generate appeals, and you end up with questions of classification in different categories. But yes, there is an audit program, and they occasionally find, property that wasn't, it's a self-reporting tax, that it wasn't self-reported. So that does happen.
So
if I may also add to that, our assessor's office does do a great job with that. We process over 1,000 tax roll changes a year on our 100,000 properties, most of which are personal property, many of them related to audits. Sometimes it's closing out, deleting accounts that shouldn't be on the roll, et cetera. But we see audits on businesses that change a tax bill from $10 to $13 or $13 to $10, so routinely. Thank you.
And then just as a follow-up, I'd be interested, Jim and
Mayor Frank, we can't.
I'm sorry. To Kevin and Jim, what would your solutions be if there could be a constitutional amendment? I don't think that's something that is too big of a hill to climb. It's happened in the state of Tennessee before. What are your 2 recommendations for how to fix this?
Constitutional amendments, you got to go through 2 general assemblies. You've got to have 50% and then 2/3. That's a lot, and it should be that way. And then you've got to be on the ballot when the governor's up. And so that's a hurdle, and it's a high hurdle, and it needs to be a high hurdle. That's when you're messing or looking at the Constitution, it needs to be a high hurdle. Solutions, I don't have them. That's why we're here, and in a perfect vacuum, we'd love this tax to go away without a constitutional amendment and local governments are made whole. We are sensitive to what local governments are going through with, the whole income tax was phased out. And so we know that there's been pressure on local governments. There's the property tax increases. Those are tough votes for local folks. We don't want to just do something and know that there's some other reaction out here, because our members on that side could feel it in certain places. So we just thought this was the place to come and get all the potential solutions in front of you, and then we can start talking again and then have a good, robust debate maybe next year about what that path is. But we haven't decided what our solution is, because we engage members like Kevin and Daniel. We're probably going to, once we see the study, we're going to survey our members comprehensively on what's in the TACIR report. And then you all know we bring that to the General Assembly and present where our members are. So we just need to be patient, learn more, engage, and then come back to you.
Mayor, I don't have an ultimate solution. I have suggestions that I believe would intuitively be evaluated. There's a significant amount of data and math for which I'm not privy to, but I can tell you what a lot of practitioners have sort of discussed. There's records that already exist, and most taxpayers in our experience are paying the franchise tax based on the net book value of their assets. And for just a real quick example, you pay a higher of, we'll say, net worth, assets minus liabilities, retained earnings, if you will, or net book value of assets. And the component of that net book value assets is often the rent factor, but also the personal property is in there. And you're required to put on that schedule under accounting principles. Now, under that example, to my point earlier, a lot of companies don't have to track that, but those are relatively small given the amount of tax we've been talking about for personal property. So you still have a significant amount. And there's some scalability, right? What we're really talking about, the serious impact are the small to medium-sized businesses. I'm from Memphis originally. This is not for the FedExes of the world, okay? You know, they've got the personnel to your point, Councilman Carlisle. So the franchise tax and evaluating something that's already there as a base would be something to evaluate, but I don't know how the math would work out. My entire career, it's been the same rate, really been the same methodology. I don't even think it's been tweaked one time to my knowledge. So perhaps utilizing what's already there, one less filing. We talk about it being a potential very much a win-win, right? You remove the compliance, a whole plethora of bureaucracy. You'd have to figure out the apportionment, which was previously done with a haul tax. You include data about the company for which you operate, and you could include additional apportionable data that's essentially already kind of framework is there of where this property resides, in which counties. If you're, say, in Shelby County, Williamson and Davidson and Hamilton, for example, something like that, you could have a very simple apportionment schedule so the counties know what's there, but definitely a larger thing to evaluate.
Thank you, Mr. Chairman. Just from a Loudoun County standpoint, our personal property is roughly $2 million annually. So now the small business owners I talk to, and I don't know our audit schedule, so I can't attest to that, but most of the small business owners that I've spoken with, they pay their 30, 40, 45 bucks and are good. And the thing that scares me especially about the potential of it going away altogether is, first of all, the impact on my county. We ate $1.5 million, $2 million when we lost the whole income tax. This is another $2 million. We've dealt, like I said, most of our small business owners, they come in annually, they pay it 25, 40 bucks. Then we run into the bigger industries that we have to, sometimes, I know our property assessor almost had to get a court order to get in. We find millions upon millions of dollars of improvement that were never reported. So, you know, I think this is a very slippery slope. I'm all about small business, don't get me wrong, but I think this is one we have to tread lightly. Thank you, Mr. Chairman.
I think Mr. Denami was wanting to get the floor.
Thank you, Mr. Chairman. I just wanted to follow up on your question about the constitutional amendment. And Mr. Jones brought this up in his testimony, and I do think it's important, and that's why I wanted to make sure I said it, that we're currently operating under Article 2, Section 28, which was from a constitutional convention. And there were 5 questions following that convention that were put to the public. 4 of them were voted down. The only one the public approved was this one, Article 2, Section 28. So I just thought for reference, it's important to realize how we got here. So, thank you.
Mayor Waters.
One of the issues, and you all might comment on this, that I have found has been forced assessment. And what happens is these folks don't realize what's getting ready to happen to them, so they just, for whatever reason, they get something in the mail from the tax assessor's office, and it goes in the trash can, or it's on a desk somewhere, and then you have a forced assessment, and then that person ends up calling the mayor's office and say, you know, they've assessed me for $500,000, and I've got about $10,000 worth of personal property. And what are you going to do about that? Because they've, you know, my tax bill now is triple what it should be. Can we reduce that? And the answer is no. You've got to pay that. You've got to pay that, and then next year we can reduce it. So that's an issue that I've found that a lot of businesses have had to address over the years, and they don't understand it.
Thank you, Mr. Chairman and Mayor Waters. It's a very good point. I'm glad you brought it up. Forced assessments are also part of the process, and because it is a self-reporting tax, and because we're working on a timeline for both tax rolls for municipalities and counties, March 1 is the deadline, and there are several leniencies that are built in, including an 18-month window to amend the schedule. So you can file a schedule on March 1, and if you haven't found the stapler or whatever it may be, you have 18 months to go back and amend that. In addition, if you file by March 1, you also get what's called a sales ratio discount. So the sales ratio discount is really important to recognize, especially as we're seeing, you know, massive investment in residential property from outside of the state. And we're seeing really strong increases in every single county now across Tennessee. Every April, the State Board of Equalization adopts a sales ratio, and I think it needs to be part of this discussion. That sales ratio is an additional automatic discount. So when you hear people talk about their self-reporting and then the tax being pretty small, it is really pretty small because it's only 30% of the value, and then there's a depreciation schedule, and then you get a sales ratio in addition to that. So let me just bring up a couple of numbers so everybody's aware. If you're in Lewis County this year, the sales ratio comes out to 0.7681. What that means is that in Lewis County, every tangible personal property schedule that's timely filed will receive an automatic 23.19% discount. So if you're in Macon County, where they have a 0.6030 sales ratio, they're going to get a 40% discount automatically just for timely filing. Now, if they're not timely filed, the assessor of property is constitutionally required to assess all property. So they have to, if they're aware, they have to assess that property. There's a mitigation statute that we worked on years ago when Mr. Jones was the executive secretary of the state board, and that allows for a reduction up to 125%. So essentially, it's a 25% overage that you would pay in the year that you didn't file timely. And then, of course, you would correct it the next year. So the forced assessment is what happens if someone doesn't file. If they do file, they have 18 months to come back and amend it, and then also they receive the additional discount of the sales ratio. Thank you, Mr. Chairman.
Mr. Chairman, just one clarification. If you don't file that schedule, tangible personal property schedule, by March 1, and it becomes a forced assessment, you lose the right to amend your schedule as well. That has been one of the more painful aspects of the law up until the time of enactment. You all enacted the mitigation, and mitigation applies specifically to forced assessments. 25% is a hefty penalty, but nevertheless, it's a whole lot better than some of the forced assessments in relation to what the assessment actually should have been. The deadline for requesting a mitigation, I believe, is now September 1 following the tax year. So that's the same time that applies to amending a timely file schedule. So those are two items of grace that the legislature has chosen to place upon this tangible personal property reporting regime. There's always been the inclination to do something about it. It's a question of how to approach it. But please do remember that mitigation remedy that Mr. Denami just mentioned, because it's not yet fully at a level of consciousness in the business community and the assessment community even that it should be.
Oh, yes.
You hit on a nerve, Mayor Waters, because when I get a call about forced assessment, it's that member's like, I had no idea. And I would have done it if I'd, just known, or maybe someone threw something in the trash. I don't know if Ms. Paris has numbers on the percentage of forced assessments per accounts, but it'd be interesting. But what we have talked about, Mr. Chairman, with state leaders in the last year or two, and maybe we can get this done while we're still trying to figure out this issue, is when a small business owner starts, they have no clue about everything. Mayor Bradshaw, they just don't have any clue about everything they're supposed to do. If they knew, they would do it. And so, what are your requirements through the Department of Revenue? What are your requirements with the Department of Labor? When you set up an account with IntenTap or with the Department of Revenue, this is kind of our dream. But if you set up that new business, you file with the Secretary of State, you've got your LLC, we just have this dream of, because of how hard this is, you get an email that says, these are the state taxes you must pay. These are the state taxes you may have to pay. These are the local taxes to be aware of. And so that's kind of a dream that we have for these startups that, they get into it, they get into year 2, year 3, and they get into these forced assessments and these places that they just didn't know. And they're not bad actors, they just didn't know. So it's part of this.
I have a question, probably for the trustee. I know we send out a notice every year that your property taxes are due. Is there any authority to send out a notice to the business owner that his personal property taxes are due?
Yes, Mr. Chairman. We bill personal property taxes at the same time with the real property billing. Just to speak to a couple of things, if I might, I'm in no way advocating to do away with the personal property tax. It is important revenue for our county. $10.8 million out of $378 is still $10.8 million, and so the burden, should it fall on real property owners, would be significant, because we'd have to absorb what personal property did not bring in. I just wanted to make sure I pointed that out. But personally, and in the conversations I've had with trustees and some of my assessor friends, I think from our end in the local government, it is how to make the process easier, more streamlined, and if there was an ability to have some sort of small business classification that was easy to report and check that box, pay something, maybe a minimum, that's still a personal property tax, but that makes that reporting component easier.
I have a follow-up question for you, if you don't mind. So the notice that you send on the personal property tax, is that just something that you do voluntarily, or does the state require local governments to send a notice to the business folks like they do, property owners?
Mr. Chair.
I think Will's chomping at the bit to answer the question, but you still have the floor. Did you have a comment before I go to Will?
There's no requirement under law, to my understanding, that any tax bill be sent. But of course, it's practically, there, of course, all trustees send them. In our office, just if I might, out of the 13,000 accounts, we've collected in Williamson County 99% of all the tax dollars due for 2021. 3 months after the due date, we're 99% collected, but only 92% collected in revenue on personal property, and half the accounts that are $10 or less are delinquent today.
Mr. Tdot.
Thank you, Mr. Chairman. February 1st is in statute and by rule. So 675-903A and State Board of Equalization Rule 600-05-041 requires the personal property schedule to be mailed to the business owner by February 1. So they do that. They mail it to whatever address is on file, and then they have until March 1 to return those to the assessor's office. And again, then once you return them, then there's also an 18-month window to amend those schedules. And in terms of ease of compliance, there have been some counties that are looking to try to go towards e-filing. This is something for 15 years now, been talking about trying to get to more of an e-filing system, one that would auto-populate the previous year's items that are on that schedule and so forth. So there have been some efforts. There's more effort that needs to be put into it to make the ease of filing done. Some counties do, yeah. Yeah, some do. But to your question specifically, February 1st, it's 675-903A is the statute, and then there's the State Board of Equalization rule as well.
Are there other questions or comments? Okay, Commissioner, and then the Mayor. And it's about 9:45, and we're going to try to wrap this discussion up at 10 to get to the other, if we can. Commissioner, and then Mayor Holland.
Mr. Chairman, I'll be very brief. I know it was mentioned that the report would look at best practices. I think the term best practice is relative, though, because it could help some and harm others. I would like to just mention that when we're looking at the report, it would be helpful to see models that really go past just what was done in the state, but look at the downstream impact to make sure that we're balancing correctly the potential loss of revenue for local county municipalities and easing the burden. So oftentimes when these solutions are made, this is a best practice, but I like to step away and take a longer view to make sure downstream that there was a balance. So I just want to emphasize that for the report. Thank you, Mr. Chairman.
Yeah.
The dream that you referred to seems like a great first step to simplifying a lot of this. Is there any reason why you can't go ahead and implement it?
Mr. Chairman? Yeah. Sorry. No, I don't think there is. When we have talked to the administration and some of the commissioners about this, there's interest. And I think it's just a matter of getting everyone in the room and seeing how this would be administered. And Secretary Hargan and I have talked about this. Commissioner Gergano and I have talked about it. I've talked about it with members of Governor Lee's administration, and that was last year, and they're interested in it. So I think you'd make Tennessee even more small business friendly to make sure that don't throw this away. Do not get rid of this email. Do not get rid of this mailing. And keep that, and use it when you're building your business. And at some point you're going to be hiring a CPA and doing other things if your business is growing. But when you're starting out, you're on your own. And so we're going to keep talking about it, but this falls under it. And also just to mention the ease of filing fee. I think you mentioned that earlier, Kelsey. I think it's $1,000. When I set up my LLC, I had a little LLC for a few years. That was great. And I just checked the box and I didn't have to deal with it. I don't know at what point an ease of filing fee gets to be unconstitutional. Is it unconstitutional? I've always wondered that myself. I don't know if that's going to be in the report, but those entities are being treated differently. They're small, but it is a question maybe to put in the report. Consider. Thank you.
Thank you, Mr. Chairman. As a business owner, I appreciate that when we have to pay the personal property tax, we are paying tax on the tools of our trade. As lawyers, our computers, our desk, our chairs, our law books are what we have to generate the revenue and income that is then taxed directly or indirectly. We also pay other fees and franchise excise taxes and all the franchise tax, all the taxes we have to pay. It would seem that, following up on Mr. McAdams, the state could simply say, we're going to eliminate the personal property tax for all these reasons. People shouldn't get in trouble for not paying a $10 personal property tax. But we'd have to figure out how to replace that revenue, and everybody says that's important too. Well, it would seem to me we could eliminate the personal property tax, but tweak the other taxes and fees that businesses are already paying to overcome that deficit in funds. But what then happens is, because nobody remembers that you cut taxes, all they remember is that you raised them, right? You know, right? And so that then everybody who would support that gets hammered on social media, oh, they're raising taxes on businesses, when in fact, reality is they're maintaining the status quo. But Mr. Brown, I guess I'll direct this to you. Would your membership be amenable to tweaking up the other taxes, right, the other revenues they are paying, in exchange for elimination of this tax that sounds like is incredibly burdensome on way too many small businesses?
It's a great question. To your first point, it's complex for everybody, so it's complex for you all as local government officials. I just think we're going to have to engage the membership to see what they're good with. What is TACIR's recommendations going to be? What are they going to be? What are potential, and Mr. McAdams may have talked about the F&E, re-looking at that. I know the Chamber is talking about some franchise and excise tax updates. I don't know what it is, but I do know that we will engage, and we have not said no. And we're here because we want to be just so respectful to you guys and to our interested parties and our folks who have to deal with this as well. So we just, again, Senator Lundberg getting this here is huge. Thank you.
Thank you, Chairman, and thanks to the members of the panel. It's been incredibly informative and thought-provoking. We've heard Wisconsin, $200 million. We heard the governor vetoed it, but I may have missed it, but have we made a projection of what, as my colleagues have aptly mentioned, to hold harmless local communities, what the total number for Tennessee would potentially be, and that way the highly successful chairwoman to my right could begin preparing for that?
Mr. Mount may have that number, the new number, or the comptroller's office. They're here. They may have an updated number.
Certainly.
Thank you, Commissioner. With the caution that we're in the early stage and we're reviewing our data and so forth, based on the data that was kindly provided by the Comptroller's Office, you can kind of estimate the revenues that personal property tax generates, and it seems like it's about 400 to 500 million statewide. And we can already tell by the variation in the assessments that it varies widely across cities and counties in Tennessee. So that's an important point. Williamson, it's like Ms. Parris said, is $10 million. They were actually kind of low as far as a percentage of their personal property tax. There are other counties, Moore County I think was the highest, where it's a much higher percentage of the personal property tax. So,
thank you, and I think Chairman Hazelwood is waiting. You're recognized.
Well, just to point out that unless I missed something here, these are local impacts, not state. So it is something that would impact all 95 counties and municipalities across the state, but it would not be impact the state budget per se. So.
Debate, you're recognized, sir.
Thank you, Mr. Chair. It's germane, but it's not directly related. But one of the issues, if you're looking for ways to potentially replace revenues that affects a county like Shelby greatly, and Representative Parkinson's district in particular, is the constitutional duties of the trustee's office are limited in scope to hold, collect, and discharge. And for when you have a county or a city that has several blighted properties that have hit and left the tax rolls and gone to the charge of the trustee doesn't have the ability to maintain those properties. And so while they are going through process, there is no way to stabilize those neighborhoods and for us to return those properties to the tax rolls via a sale, because they've just dilapidated and deteriorated into nothing. And so the city of Memphis has tried to come up with quasi-governmental agencies like the Blight Authority of Memphis that can take those properties and at least pretend or act as a trustee for them. So one of the things that would be interesting to look at is a constitutional amendment to the trustees' responsibilities and really capabilities to protect the properties themselves And my point would be is that, when you look at, again, the city of Memphis and all of the properties that have left the tax rolls because of that, and then what's happened in those neighborhoods, the values have depressed so much. But if we could stabilize those neighborhoods through the trustees' ability, there's a potential to make up that revenue once they hit the tax rolls again. So just a general thought, but it's kind of big game hunting, but it's a problem that plagues our city, especially in the structure that we have, being 2/3 of the county, but having a constitutionally elected officer. It's very difficult to work through that when you're trying to just say, hey, we're happy to cut the grass and board up the windows and stabilize the property, but it's in your charge. So something to look at as you're trying to think through alternative revenue streams. Thank you.
We certainly appreciate your staff, Director Lippard, for putting together such an excellent panel for us today. We really appreciate the really good information you've given us today, and it's certainly very thought-provoking, and I'm sure that the suggestions you've made will be incorporated by the staff as they do their research, and the questions have been very good as well, too. So thank you very much. We'll conclude this portion of the agenda today as we go to tab 9, Fiscal Capacity for Fiscal Year 23. I think Presley Powers, our Research Association, will make that presentation. As you depart, thank you again. This, I was telling the Vice Chairman, this will be a tough needle to thread.
Agreed. That's why they used to wear thimbles.
Yeah. That's why we're here. Sorry.
Good morning, everyone. My name is Presley Powers, and I will be delivering this year's annual update on fiscal capacity. Before I begin discussing fiscal capacity, I wanted to briefly describe to you all the BEP funding formula, which is our current funding formula for fiscal years 22-23, and will be replaced by TISA, or the Tennessee Investment in Student Achievement, in fiscal years 23-24. So the BEP, or the Basic Education Program Funding Formula, determines the amount required to fully fund the BEP based on the cost of providing more than 40 components necessary to operate schools. The local and state share is set by law to divide responsibility between the state and local governments, and you can see here on the screen the components that are outlined in the division between local and state contributions. These components are instructional salary and wage cost, instructional benefit cost, other classroom cost, and non-classroom cost. Fiscal capacity is used to allocate local shares among counties and is determined by taking an average of the TACIR model and the CBER model. States make up the difference, and this is determined by taking the total cost of the BEP minus the local share for each school system. Fiscal capacity essentially answers the question, how much must each local government contribute to the BEP? And is a measure of the potential ability of local governments to fund education from their own taxable sources relative to their cost of providing services. This is a county level model, meaning that every system within the county is treated as though it has the same fiscal capacity. I'll briefly discuss the methodology in calculating fiscal capacity. We use a multiple regression analysis, which is a common statistical method used to understand relationships among factors for a wide range of issues, while simultaneously comparing all variables for all counties to determine how much weight to give each factor. Weights are multiplied by the factor for each county to estimate potential local revenue for each of the 95 counties, with actual revenue serving as a control. Factors used in TACIR's fiscal capacity regression: own source revenue per student. This is the actual amount of money local governments raise to fund their schools, divided by enrollment or average daily membership, which is frequently abbreviated to ADM. This is the control factor that keeps the estimates within the bounds of what local governments actually do. Sales tax base per student: this is the locally taxable sales for the county area divided by ADM. This is a measure of the local ability to raise revenue. Equalized property assessment per student: this is the total assessed property value for the county area, equalized across counties using an appraisal to sales ratio, and then divided by ADM. This is also a measure of the local ability to raise revenue. Equalized residential and farm assessment divided by total equalized assessment is a proxy for a county's potential ability to export taxes through business activity. The higher this number, the lower the level of business activity, and the higher the risk of heavy tax burden for county residents. Per capita income is a proxy for county residents' ability to pay for education and all other local revenue not accounted for by property or sales taxes. ADM divided by population is a reflection of spending needs. The larger the number of public school students per 100 residents, the greater the fiscal burden for each taxpayer. To explain how these factors affect fiscal capacity, factors such as property tax base, sales tax base, and per capita income, as those things increase, fiscal capacity also increases. Comparatively, as residential and farm share of property and service burden increase, fiscal capacity actually decreases. County trends and share of statewide fiscal capacity. The change in a county's share of fiscal or of statewide fiscal capacity depends on its growth in fiscal capacity relative to the other 95 counties, or the other 95 county average growth in fiscal capacity. Another way to state this is the amount that one county increases or decreases, the other 94 counties must increase or decrease by that same amount to make up the difference. This is a zero sum. A county whose fiscal capacity grows faster than the 95 county average will increase its share and vice versa. I'll now bring your attention to the map on the screen, which examines long-term fiscal capacity trends by county. You'll see that counties highlighted in green are trending upward, those highlighted in yellow are holding steady, and those trending downward are highlighted in blue. I'll leave that for a moment as you all can identify your counties. But I would also like to specifically draw your attention to Hamilton County, which is highlighted in blue, meaning it's trending downward. Another way to visualize the trends relative to the other counties, you can see here on the screen Hamilton County, the red line. If you were just looking at this graph, you may say, well, Hamilton County's, the line's going upward, so why is my fiscal capacity trending downward? I can explain that if you'll also look at the blue line, which represents Tennessee. You'll see that Hamilton County, while the line itself is moving upward, it is below the Tennessee average, meaning because of fiscal capacity being relative, that county's fiscal capacity is actually trending downward. And here's another visualization of this same component. And you'll see as fiscal capacity for a county decreases, the other 94 counties are responsible for a greater share of the BEP local match. I'll end by discussing effects of the COVID-19 pandemic. The following variables appear to have been affected by the COVID-19 pandemic. Overall statewide local sales tax base increased 1% from fiscal year 2018-19 to 2019-20 and has increased 9% from 2019-20 to 2020-21. Overall statewide ADMs decreased 2% from fiscal year 2019-20 to 2020-21. And overall statewide per capita income increased from 2019 to 2020 in line with recent trends because of pandemic relief payments in 2020. Other factors to consider when understanding the effects of the pandemic: fiscal capacity is again relative to the other 94 counties, and TACIR also uses 3-year averages, meaning many of these effects are still emerging over time. That concludes my presentation, and I'll open the floor to questions.
Thank you very much. Are there questions for our... Well, there being none then, Mr. Director, we don't need a report on this? Okay. A vote, rather. All right, thank you very much.
Thank you.
The comprehensive litter review update given to us by Ms. Berry, our research manager. Jennifer Berry, you're recognized, ma'am.
Thank you, Mr. Chairman. Good morning, members. My name is Jennifer Berry, and this morning I will be giving you a brief update on the litter grant data that you requested at the last meeting and a summary of the municipal and county surveys that we conducted. And the memo is behind tab 10. And just a reminder that we will present the draft report at the fall 2022 meeting and the final report in January of 2023. Now, the first table is on page 3 behind tab 10. That table shows county-level data for the Tennessee Department of Transportation's litter grant program run by the Highway Beautification Office. For the last 5 fiscal years for each county, the table shows the annual litter grant allocation, the amounts spent and unspent by the county, and the percent of the county's total allocation that was unspent. In interviews and survey responses, stakeholders said that the COVID-19 pandemic affected their activities and ability to spend funds, especially on litter pickups and education activities. As a result, many spent less of their allocated funds in those 2 years that were affected by the pandemic. And those years are shaded gray in Table 1. The second table is on page 19, and that shows each county's total annual litter grant allocation, the amount of each county's allocation that's allowed for salaries and direct costs, and the minimum percentage and resulting amount of each county's allocation that must be spent on education activities. Counties are required to spend a percentage of their litter grant funds on education each year, and each county is in one of 4 tiers. So 20%, 25%, 30%, or 35% of the allocated funds are required to be spent on education activities. And the tier that each county is in is based on the county's population and the number of road miles. I also want to remind you that any allocated litter grant funds that the counties do not spend, including their required education portion, do not revert to the state's general fund. They remain in the litter grant fund, and every few years, the Tdot Beautification Office distributes these unused funds in the form of competitive grants that they call special litter grants. And local and state government entities or nonprofit organizations can apply for these grants to implement community-based projects that address litter and illegal dumping. And finally, after those 2 tables on page 22, you will find a summary of the results of the survey that we sent to all county and municipal mayors. The series of charts shows the responses to each question in the surveys. Out of the 95 counties, 59 responded to the survey, and of the 345 municipalities, 114 responded. Overall, most survey respondents said litter and illegal dumping are a problem, and the situation has not been improving. Although based on their responses, the problem in cities isn't perceived to be as bad as in counties. Overall, respondents said litter pickups, education, and enforcement help, and they would like more of these types of activities. And we also received many helpful comments that we are working on summarizing, and we will reach out to a few respondents, both city and county respondents, to get a little more insight on their responses and comments. Thank you. I'm happy to answer your questions.
Mayor Holland, you're recognized.
Do we have anything yet on where the money that's been collected from the tires has been going? That I know we had talked about one time that we were all the counties were supposed to get some type of a machine that would shred the tires, but none of us have that, and they have to go out of state to do that. That was my understanding. So have they found anything in regard to where that money has gone or why we don't have those machines in our counties?
We have been looking at the tire fee money that's been going to each county, been looking through their audits, and I don't have that summarized for you today, but we are looking at that, and we'll have that for the draft report, and we'll look into the, we'll have that information for the draft. Mm-hmm.
Are there other questions? Are there other questions? All right, are you ready? Mayor Brooks, Vice Chairman.
Although clearly I don't appear ready, I am ready, Mr. Chairman. Thank you, Ms. Berry, again for the work of this update, and we're very much looking forward to the report when we receive it from you, I believe in December. Interesting, and I'll just begin with Director Lipper just tried to reassure me that response from 59 counties is actually good out of 95. However, it's not good enough, I think, to begin to illustrate the big picture, not just of tires, but I think of litter in general. That'll just be my first comment. Because I think it's important that we have a very comprehensive look, as was mentioned at our last meeting in the minutes we approved yesterday, of the very old studies that we're still using, 06, 12. So I think some sort of comprehensive litter study in the state of Tennessee is incredibly important as we move forward. Another topic that I wanted to just ask, the incorporation of other things other than just tires, that's what's getting on the headlines right now, but glass and plastics. And I was actually having dinner last night across the street from my hotel, and a shopping bag was blowing around like a Mary Poppins movie. And I kind of watched it go 2 or 3 stories high. I'm not young enough to grab my phone quick enough to snap a quick picture of it. But I thought, here we are studying litter, and it's literally right here at the corner of 4th and Union. Are we going to incorporate all of those things in this December study, and is that a part of the scope since we're still in the planning process of what this report could include?
When you say incorporate all those things, just the amount of glass and plastic, I mean, yes, as best we can to keep it within the scope.
Great.
I think.
Great. And then the only other thought I had is, as this has moved forward, it is surprisingly and pleasantly surprising how many corporations seem to have this as part of their business plan now, whether you're in glass or plastics or tires or anything. And I'm hoping that we'll be able to hear from some of the corporate side of this. I was fearful that this litter study would anger or not be well received in some industries, but I'm pleasantly surprised. We have some industries in Cleveland, Tennessee that have reached out directly to me and said, Mayor, we want to help. We want to be a part of the solution of this within our own corporate footprint. So I would love to make sure that in addition to the counties and the municipalities and the grant funds, that we also take a look at that as well. Thank you, Mr. Chairman.
Thank you. And I have a question, ma'am, maybe a couple. I noticed that we only had, on some of the questionnaires, we only had 59 counties participate. It's about 60% of our counties, so 40% did not. Is that a common percentage, or do you consider that a low? I mean, is that?
I think for surveys in general, that's pretty high.
Really?
Yeah.
Okay.
I mean.
All right. And
Cliff,
all right.
I would add,
it
depends on, for our standard survey, just like surveying the general population or something, that would be very high. For our survey, since we have a very limited universe that we're surveying, the counties in Tennessee, the cities in Tennessee in most cases, it depends on how It depends on the particular survey and how much emphasis there is put on the survey either through the statute or through the associations working with local governments. But generally speaking, that's still a pretty high number for a survey of local governments for us.
I have one other question, just about trying to understand the data. On the one table where you showed the amount spent for salaries and the amount spent for education, with reference to I presume these numbers were provided to you by the state of Tennessee, but has there been any effort to look through on the amount of money for salaries, just how this money, how the money for salaries is being spent in some of these counties? Are the salaries that are being funded tied directly to litter abatement, or are we just we're not supplementing an employee's salary with a little bonus from this fund? There's a definite. I've lost the word here. In other words, there's a definite trail there where we can make sure that the money is tied to litter abatement.
Right, and that's what the beautification office. That's their job, is to make sure that that money is being spent on litter.
I presume that you're talking to them, though.
Oh yes.
Okay, thank you, Senator. You're recognized.
Thank you, Mr. Chair. Are there any parameters set on the educational component?
Yes, there are. And those are all laid out. They have a manual that for the litter grant program, and they're laid out in detail in there. And there's certain education activities the money can be spent on. Actually, I have it right here. For example, for the education expenses, they can that money can be spent on litter pickup activities, prevention education, and recycling education. And then the areas of focus should include student, business, public, government, and media educational activities. And then there's a list of approved expenses and some that wouldn't be approved. So it includes salaries and benefits that would be specifically for the education, and materials and supplies and other things. But it would have to be for education activities.
Thank you. So I wonder if there's been, I don't know when that was established. My concern is, when China stopped taking our waste, and we found that there was much less of an incentive to recycle in terms of the market capacity for that we found ourselves in a situation, and increasingly are finding ourselves in a situation where the concept of recycling is not really actually solving any problems, and so that the educational component of it might need to move in the direction of encouraging reduction juxtaposed to recycling. And I don't know if that's something that gets updated or modified, but I think that's such an important thing to pay attention to when we're talking about education.
Thank you.
Mr. Peach, you're recognized.
I just wanted to make sure that I was reading this right. Is there a Tdot litter grant program for municipalities? I noticed that it doesn't appear that the counties are sharing any of this money, or at least nobody's reporting that the counties are sharing this money with the municipalities, where some of the denser populations are going to be.
It's a litter grant program. The money goes to counties, and we asked that survey question. It doesn't mean that counties aren't working with cities in different ways on litter and dumping, but litter grant money does not go directly to municipalities, the way the program is set up.
And can the study include maybe any kind of recommendations with those types of things? I just think that's where generally most of your dense populations are going to be, which I would assume you're going to have more trash if you have more people outside of a rural area that might be a little easier to dump and get away with. But I just found that kind of disturbing, I guess.
And I will also note that, and that's a good point and something we can definitely look at, the special litter grants with that funding that stays in the litter grant fund and goes out for the competitive special litter grants. Cities they can apply for those grants, so that is one option for cities.
I think Mayor Frank is waiting for the floor.
And just as a follow-up to that, we do, it may not be reflected, But for beautification, we actually give beautification dollars to organizations inside the city limits, so then they do their own thing with that. But just a couple of things. One was a note on page 28. I thought it was very interesting that both the municipalities and the counties said additional funds. The majority would like more litter pickups to use them for direct litter pickup. But the question on enforcement, we heard from the panelists when we were discussing this, the real need for enforcement for anti-littering. But the results I thought were kind of interesting. So for the counties, only 21% said if more funds were available, how would the county use the funds? Only 21% said for enforcement. But I think, just for myself personally, we're not in the business of enforcing. That's someone else's job. And so I wonder how much of that response to that question is tied to just an inability to use those dollars, and is there another way to perhaps track that answer for the report on need for enforcement? Is there another way to measure it that we might look at? And I'm just throwing that out there.
Vice Chairman Brooks, and then Mayor Vickers.
Sure.
Chairman Brooks.
Thank you, Mr. Chairman. And I want to follow up on Commissioner Thomas's comments at the prior presentation with the panel about best practices, and will this study, when it's finalized, include the best practices or any practices from other states and how they are preventing litter in their states and how that's going as it relates to Tennessee? Thank you.
Yes, we will include that.
If looking at table 2 here, for example, I'm curious if counties use inmate litter pickup crews, would that be a way that some of these funds going to the counties are being used, or do we know, when we've got the raw data, county spending X? Do we have any data as to how each county is spending it, whether for inmate litter crews or however it's being used?
So they can spend their funding on the inmate pickup, and a lot of them do. And I could probably work with beautification office on more detail. They're in the audience here to get more detail on that, on how they're spending for or just for all the different activities. The breakdown of how the funds are being used.
Yeah, I mean, we've been tasked with trying to identify ways to improve the system, and I think that'd be helpful to see just exactly how these dollars are being spent today, because you could make an argument that maybe the litter crews ought to be funded another way so that monies could go and be available to, whether it's for dealing with waste or things we have. Or if it's a situation where that's the only way counties can do that, then that'd be good to know too. But I would like in this report we identify just exactly how these monies are being spent now, more than just we got a number that shows here's how much this county is spending on salaries and education.
I think that was what I was trying to get at in my question too, but I think you were far more articulate. Thank you.
Thank you, Mr. Chair. I want to piggyback on Mr. Peach's comments. When you look at a county like Shelby, where the city is 2/3 of the county, certainly those monies and coordination does occur. It also depends who's in office, who's running the show. But recently, in recent years, we've had great coordination on many efforts with our county partners. But in reality, it's the Memphis Public Works Department that is responsible, and its own division of solid waste that is responsible for tackling illegal dumping and littering, whereas the county's solid waste department really doesn't have that infrastructure. So, not to belabor the point, but I think it's critically important as you're looking at these, because to be honest, I hate to speak ill of the city that I love, but Memphis may be the dirtiest it's ever been. And we as a matter of fact, on Tuesday at our council meeting, are going to consider a resolution forming a task force, which I'm not a committee for all committees kind of person, but it's such an issue for us tackling illegal dumping around the city tires. And we, in our unique geographic position, I mean, we've got people coming across state lines to do it. And so we really interested in how we could potentially look at direct funding to the municipalities in specific instances, to the point that we have our own solid waste division to deal just with that. So I really look forward to seeing what you guys will propose. But thank you.
Just a comment to let you all know how one entity, and that's us, spending the money. We have an education program in the school system. It's either the 4th or 5th grade that we fund countywide. And then, in addition, we spend several $100,000. We've got 3 crews picking up litter, and it picks up litter in county and cities. I mean, we're not concerned with the boundaries of cities. We pick it up everywhere, but we do have 3 crews, and part of that, most of the funding is coming from local funding, not this. We use what we got, but we do fund additional crews and also use the money for education for all the students.
Thank you. And thank you for your presentation today. I believe our next tab 10, is other business. I'll defer to Director Lippert. I believe yesterday there was a discussion of an amendment to the proposed bylaws, and you can, if you will, I'll let you have that subject.
Thank you, Mr. Chair. So as you'll recall, yesterday it was raised that we should add some type of limit or control to the proposed Article 3, Section 18 bylaw on remote meetings, on when those would be authorized. And so staff worked on that some after the meeting yesterday. And we've come up with language on this, but I'm going to leave with the caveat that I don't think this Section 18 is necessary. After we put the restrictive language in there, it became clear that this is already in place as it is. And let me explain. And that the reason that bodies like ourselves were allowed to have remote meetings and that it was legal was the series of executive orders that suspended the requirements of the statute. Those executive orders laid out all of the requirements for those meetings, to include allowing votes to take place, the rules on quorums, et cetera. And so what we had added in the proposed language was that the chair could determine if it was necessary, and that there was an executive order in place allowing it at that time. Well, if that's the case, if the executive order is in place, there's no real reason for us to put this in the bylaws. So what I would recommend is that we consider the amendments to the bylaws minus the proposed Section 18, and we'll strike that from the recommended changes we're asking you to vote on.
I want to add parliamentary inquiry from our secretary. Is this on the floor? Was a motion made yesterday to put this on the floor? We need a motion today to adopt the. We had a motion to adopt, but not the amendment. All right. So there is a motion on the floor to adopt the bylaws. Chair would entertain a motion to amend the bylaws to delete Section 18. There's a motion and second. Do you understand what we've done here? Okay. Any questions? Those in favor of the motion to amend to delete Section 18, which has just been explained by the director, say aye. Opposed, nay. Carries. Now we have in front of us the amended motion to approve the bylaws. Do you have any questions? Those are submitted to you, and I believe the director reviewed those with us. Do you have any questions? There being no questions the motion is to approve the amended bylaws. Say aye. Those opposed, nay. Carries. The motion to approve the bylaws as amended carries.
Thank you, Mr. Chairman. The only other item under other business is the setting of our next meeting dates, and then with the approval of the members, what we will do is poll the members for potential dates, probably in September.
All right, that'll be. I think everybody's satisfied with that. And before we adjourn, I do want to take note that we were delighted to see that Mayor Waters was here at 8:30 this morning. So we're very pleased to see that. Is there any other questions or business to take up? If not, we will stand in adjournment to our September meeting.